You're listening to Southeast Radio's Business Matters with Karl Fitzpatrick in association with Wexford Insurances. Challenge us at Wexford Insurances 0818 31 30 30.
Welcome back to Southeast Radio's Business Matters with me, Karl Fitzpatrick. I'm now joined in studio by David Maher, Managing Director of Wexford Financial Services. Good morning, David. Thank you very much for joining me this morning.
Good morning, Karl. Thanks very much for having me on the show.
David, you might start by telling me a bit about your own background, please.
Well, Karl, my name is David Maher. I'm married to Helen. I have 3 kids. I've been living in Wexford for about 8 years. I grew up in Dublin and I went to school in Fairview, St Joseph's CBS. While in secondary school, naturally I had an interest in business, and business studies was my favourite subject. At the time, well, still my favourite uncle even now, but he worked in the insurance industry and I took an active interest in his career, and he, to be fair, took an active interest in where I was going academically. And I liked the whole insurance field, and he did research for me, and he pointed out that the University of Limerick had an insurance degree, at the time a 4-year course. So I applied for that, got it, went to Limerick, had 4 fantastic years, including 2 work placements down there, which stood me well when I came back to the employment market when I graduated, which was in 1998, and I was recruited by a large insurance company at the time, worked in the group pensions department, and within a short period of time I was given a junior management position. While there, I knew everything that you needed to know about group pensions, and I just felt that I wanted to get out there and into an advisory role. And this coincided with a decision both myself and my wife Helen made. My wife's from Wexford, and we decided that we'd like to relocate to Wexford to raise our family there. So 8 years, I moved down to Wexford, met up with Ken Lawler, the two of us sat down and we set up Wexford Financial Services.
Well, David, the reason I've asked you to come into the studio this morning and speak to our listeners is to brief them on this new European Gender Directive that's coming into force from the 21st of December. What's it all about?
You're right, Karl. There is a new EU Gender Directive coming into play 21st of December 2012. It's a very important piece of legislation. I'm not going to bore listeners with the background to it, but basically what it means is that in future, life assurance rates, income protection rates, etc. cannot be determined based on a person's gender. Now, what that means is that traditionally, life assurance companies would have rated, would have come up with rates for life assurance for women and men based on claims experience. To give an example, women live longer than men, that's just a fact, and they're less likely to die during the term of a policy. Therefore, traditionally, women have paid less for life cover. On the flip side, women tend to claim more on income protection plans, so they pay more for income protection. Now, the effect of the EU Gender Directive is that you're going to have an equalisation of rates. And the reality is, at the moment, women pay up to 30% less than men for life assurance. But for any women who are looking to take out life assurance, if they leave it to the new year, they're going to be paying probably about 30% more. And for men as well, particularly self-employed people who should have income protection anyway, if they're thinking of taking it out, come the new year, the difference in rates between a man and a woman now is about 50% more expensive for women. So it's deemed likely that the cost for males in the new year for new income protection policies will increase by anything up to 50%.
Well, David, that's certainly going to have a serious impact on the market itself. Just in relation to life assurance, I was reading a report there recently that 1 in 2 adults do not have life cover. These people must feel that they're bulletproof.
Karl, there was a survey carried out by a leading research company not too long ago, and indeed 1 in 2 adults does not have a life assurance policy. And even the 50% who do, of that 50%, a third of those just have a mortgage protection policy only, which is the policy taken out to cover your mortgage. Now, another study that was done recently shows that women in the home, if you were to put a cost on the amount of work they actually do in the home, it comes to around 35 to 40,000 per annum. Yet, although women tend to take the lead in running a budget in the household, or take the on the financial side, surprisingly, women are very much underinsured. So yeah, to give you an idea, Karl, one of the leading life insurance companies have paid out $1 billion in protection claims over the last 5 years, and even this year, the same company have paid in the first half of the year about 12 million. So it's money that's needed to run a household after the death of a main earner, or to replace the work a woman in the home does, for childminding, that type of thing as well. It's huge, it's critical.
Yeah, I was going to put the point to you that there is a perception out there in the market that insurance companies at all costs look at trying to get out of paying out claims in the event of a death. Is that the case?
It's not the case. I can absolutely assure you. I'm working in the industry 15 years, and I've yet to see a life assurance claim declined. Now, that's not to say that they aren't. Roughly speaking, the figure that one of the studies I've done show that maybe 1%, possibly 2% of life assurance claims get declined. And just to give listeners an idea, when you take a life assurance policy, you obviously fill out a questionnaire with medical questions. There is a concept in insurance called a material fact, and that means that you disclose anything that you believe could influence the insurance company taking on the policy. So it's only in the case of blatant non-disclosure, Karl, and what I mean by that is somebody who knows they have a terminal illness, who doesn't disclose it, and then they die down the line. Or you could have a situation, some people mention about smoking. If somebody's a smoker, they don't disclose the fact that they're a smoker. Now, if they happen to die of something like lung cancer, chances are that will be declined. But if they die due to being knocked down crossing the street, the insurance company aren't going to go back over the files to find out they're a smoker and therefore turn down the claim because of that.
I suppose, David, people have the approach that will never happen to me. But for those listening to the show this morning, we might be setting a seed with them where they said to themselves, well, you know, in the event of a death, in the event of my death, what will happen to my family afterwards in terms of how are they going to survive from no income coming into the household from the main earner? So on that basis, what advice and tips would you give to people today that would be considering taking out life assurance?
A very good question, Karl. There are a number of tips. The first one would be to shop around, because there can be considerable difference in the price of even what we'd call a vanilla wrapper life assurance policy, and the difference in price can be anything up to 50% between the most expensive and the least expensive in the marketplace. So that's tip number one. Tip number two is to make sure the amount of cover that you're taking out is adequate for your family's needs. And indeed, there has been innovation in the market over the last couple of years, whereby traditionally, you know, it was selected, sum assured was selected maybe 250,000. Indeed, that was the average in the marketplace, 250,000. But really, was that adequate for people's needs? So there's been innovation whereby an individual could select an income amount to be paid out in their death. So they can work out, what would my family realistically need if I died? And if that was, say, 3,000 a month, they can cover that for 20 years, as well as a lump sum amount. And what that's led to is actually an increase in the marketplace, more accurate advice. So if you're ever given a recommendation for a sum assured, question it and ask where it's come from.
Pensions, I'd like to have a quick chat to you about those, because lots of business people especially have stopped paying into them over the last couple of years since the onslaught of the economic downturn. Is that your experience with your own clientele?
Well, it is, Karl. To be fair, when the economic downturn was hitting businesses, I saw it very quickly, because a number of people who had pensions taken out were cutting the amount they're paying in, or indeed stopping altogether. And I could understand it, because they're needing to cut overheads and a pension wasn't an immediate priority for them. Having said that, you know, if somebody out there has stopped paying into a pension over the last 2 or 3 years for this reason, perhaps they should need to re-examine it, because they lost out on 2 to 3 years funding in the meantime. Also, Karl, not only the economic downturn in terms of affecting a person's business and ability to pay in a contribution, but on closer examination sometimes when I sat down with business owners or pension holders, oftentimes, you know, they're dissatisfied with the fund that was in and they felt they're throwing good money after bad. It's important to point out that many of the equity-based funds that were invested in have bounced back very well over the last 2 to 3 years, but also there are a number of capital secure investment options available. And there has been a trend over the last couple of years for people who are saying, I'm happy to secure my tax break, and now I want to put my money into something that's just purely deposits. And the high deposit rates that are available over the last few years have proved popular for this purpose.
David, in simple terms, a pension is no more than a long-term savings plan for their retirement. Certainly, lots of people have lost all faith and confidence in pensions over the last number of years. What's it going to take to get that confidence back into the market?
It's a good point, Karl, and there are a few issues there. Certainly, I would reiterate, that is exactly what a pension is. You put it very well. It's a long-term savings account, really, but that has added tax relief incentives. And it's important to point those out. People's confidence has been eroded in pensions recently because the government have scaled back on the level of tax relief that was once available. And indeed, there's still some uncertainty surrounding it into the future. But if I could point out the tax reliefs that are still there, are still very attractive to our listeners, is number one is income tax relief, so up to your marginal rate of tax. That's currently still the case. So if you're paying tax of 41%, you're still entitled to tax relief of 41% in your contribution. So, €100 contribution costs you €59. Secondly, when you contribute to a pension fund, any growth in that pension fund is exempt from dirt tax or capital gains tax or investment growth tax, and currently it's allowed to roll up then within the fund, and currently that's a concession of 30% for dirt, 33% for investment growth tax. Thirdly, when you reach retirement age, you're allowed to take 25% of the fund up to an amount of 200,000 out completely tax free. What needs to be to restore confidence is the government need to step back and recognise that if they reduce tax relief incentives, it's affecting many SME owners, many middle class people. And the reality is this, Karl, that at the moment there are 6 adults working for every adult that's retired, and by 2050 this is deemed to go to reduce to 2 working for every 1 retired. So like it or not, the state pension may not be there in its current guise. For yourself, myself, Karl, it's going to be 68, whether it's even there or not. And also for self-employed people and people in general, you know, the government have made some changes behind the scenes that's going to make it more difficult to even qualify for the state pension in the future. Karl, can I just say before we move on that regarding pensions, I'm not saying for one moment that anybody out there, whether it's a normal person or a business owner or whatever, should put all their eggs into one basket, i.e. the private pension route. A private pension, it's not the be-all and end-all. It's not the perfect product out there. However, with the tax incentives that are there, it should not be ignored, and it should definitely form one strand of an overall effective retirement strategy. And the other components of that can be a person's business, it can be a person's investment property, it can be an inheritance, it could be a savings plan, but you get the picture.
Just in relation to income protection, lots of our listeners this morning are self-employed people. So if, for instance, they go out of work sick, they're not going to be entitled to any social welfare benefit in that regard. What options are available to business owners from an income protection perspective, David? You're
right. If you're a business owner out there, and a lot of people even whose business have failed have found that the state haven't been there to support them. But if you're a business owner, you should definitely consider taking out an income protection plan. Before I go further, I should point out that oftentimes an income protection is a word bandied about, used to cover all types of policies. There are a lot of differences between the policies out there. I'll explain very quickly if I could. Income protection allows you cover up to 75% of your gross earnings, okay? And it will pay out if you're not able to do your own job. And that's important. It's your own job due to any illness or any accident, any disability. And it will pay you out this income up to age 55, age 60 or age 65, and it's up to you to choose which end date is on the policy. It's the premiums for it are tax deductible as well as a business expense, or for listeners out there paying under PAYE, they'll get up to 41% under that as well. There are other plans out there, and sometimes it amazes me, because I'd be speaking to somebody and I ask them, do they have cover like this, and they tell me they do, they have an excellent plan in place. But when I drill into the plan, look at it more closely, it turns out it's more like a personal accident plan with a bit of illness cover built into it, and it might only pay out for maybe 6 months, maybe a year, and typically the amount that's being paid is completely inadequate because the person doesn't review it on an ongoing basis. Having said that, these plans have a role to play, no doubt about it, and not everybody out there is entitled to take out an income protection plan.
I think one of the biggest problems with income protection is that it's so occupation specific.
No doubt about it, and that's why I just mentioned not everybody will get an income protection plan, for 2 reasons. First of all, medically speaking, if you think about what income protection is, they're concerned with you not being able to do your job, and this can be due to any reason such as stress, or it can be back related. So if you fill out an income protection proposal, the underwriting initially at the start, and this is not to scare anyone off, but it is to put the facts out there, it is a bit more rigorous than a life insurance policy, because with a life insurance policy, whether you've had a bit of a back complaint is of no major concern, but with income protection it may be. That's the first thing, is the medical side. But secondly, it's occupation based, so it's scaled on a scale of 1 to 4. Basically, somebody who's in an office will be occupation class 1 and won't pay as much as somebody who might be in heavy labour in occupation class 4. And even certain occupations like farmers, hauliers will find it very difficult to get income protection, or they may be entitled to take out some form, but it won't be the same as other people.
The final topic I'd like to discuss with you, David, this morning is business insurance, and specifically key man insurance. From my experience, it seems to be an area that business owners in general have very little, if any, knowledge about. Can you enlighten them this morning?
I can indeed, Karl, and it's an area of that we take great interest in, because a study has shown recently that 50% of business owners aren't aware of key person insurance or business insurance. And I hope I can make the argument for it today and people can see the sense in considering it. There's two main types that I'd be concerned with. Number one is key person, and you could be a business who employs somebody who's very central to the success of your business, and if anything happened to them, as in if they died, your business could be at a significant financial loss. So this could be a top performing salesperson who might be pulling in whatever 200,000 or 300,000 euros a year for you, and you're entitled to essentially cover that person if they died, to cover the business for loss of profits arising out of that person's death. And what that will do is, the life insurance payout will allow you then to recruit someone new, and if they're not bringing in as much as the other person, you still have that payout from the life insurance company to tide the difference over. The second type, and I believe this is an area that a lot of business owners should be very interested in, is what I call co-director insurance or partnership insurance. If you take a company that might have 4 directors, Karl, let's say they each have an equal share, 25% in the business, the company is entitled to insure the shareholding of each of those directors. Now, why would they do that? Well, let's say one of the directors dies. What's the agreement that's in place? Is a spouse going to come on board, looking to take some role in the business? Is the spouse going to be looking for a payout? Is the company going to have the money? So the thinking behind it is, the rationale is, let's say the business is valued at 2 million. Each shareholding is worth 500,000. The company simply takes out a life insurance policy on each shareholder for 500,000. In the event of that person's death, the 500,000 is used to buy out the deceased shareholders' share of the business, and it's a win-win because the company continues on the correct ownership structure that they wanted, and the spouse of the deceased director receives fair value and receives prompt payment for the shareholder.
David, look, we're out of time, but I'd like to take this opportunity to thank you for coming in. It's been a very informative interview, and I wish you continued success with Wexford Financial Services.
You're listening to Southeast Radio's Business Matters with Karl Fitzpatrick in association with Wexford Insurances. Think Wexford Insurances for your business insurance.